Every successful trade starts with the right analysis. If you miss it, you'll be gambling with your real money. But what if you could see the next big move of the market before they even happen? From this point, how can you tell? Is the market going to go up or down? So we will cover all the technical analysis tools that you need to tell and predict the next move of the market. But we'll also show you the importance of high time frames in your analysis, how they can impact the way you trade in the lower time frames. In this case, if you take a look to the left, you see there's a very important level here, the support level. So from this point, you see your prediction might change due to what has been formed previously. Here is what we will cover in this video. First, support and resistance level. Second, chart patterns. Third, Fibonacci retracement. And fourth, trend lines. And last is about live example and case study to see how these principles align and you can apply them in your real-time chart. So, technical analysis. Basically, and in simple terms, it is the study of historical price movement, which help us to forecast and predict the future price action. So, the main goal of any trader is to analyze what the past data means to him and come up with an idea or picture of the future price movement. Unlike the fundamental analysis, which usually looks at the economic indicators and mainly news events, technical analysis focuses on price charts and price patterns, which help us identify trading opportunities. So, understanding this approach is very essential for anyone who is serious with forex trading. Now, support and resistance. To understand this clearly, you should understand the concept of multiple time frame analysis, which simply tells you that the higher time frame is more important to the lower time frame, which tells you that the analysis and whatever it is that you do on the lower time frame should align with that of the higher time frame. However, there are some traders who sometimes they trade against what is in the higher time frame, but what is important here is to understand and to have a picture of what is happening in the higher time frame. So always the higher time frame is the most important time frame, and you should have a picture first before you can go down and trade or analyze the lower time frame. If you take a look at this example here, this is a chart of EURUSD on 4-hour time frame. You can see the chart is clearly on a downtrend movement. This is indicated by the downtrend movement as well as the strong bearish candles, as you can see. But if you apply the principles of multiple time frame analysis, you go to the higher time frame. This is a daily time frame. You see there's a very clear key point which might act as a price rejection point in this movement to the downward. So if you're trading on the lower time frame, always remember and always apply the principles of high time frames effect so as you make decision. It doesn't matter how strong your analysis on the lower time frame is, they will be discounted by by the picture of the higher time frame. As you can see here, there was a strong zone that indicated the price retested on this zone and we're about to keep going lower, but due to what happened previously on the left, you see from higher time frame, the daily time frame, you see price was rejected previously, and this area might act as a rejection point again in the future. So the support and resistance levels. These are the levels in the market where price is most likely to change direction. So, whenever you see price heading toward these levels, it's most likely to reverse and change direction. When it comes to support, market will reverse and change direction heading high. And when it comes to resistance level, market will change direction and fall down. It depends on the importance and the time frame in which you draw these levels. But it is very important to consider these levels as zone and not as a particular point or a fixed point or level in the market. So, this is how I categorize my support and resistance levels. I categorize them into 3 different categories of the support and resistance levels, so as to help me understand the strength of each of my zone. Remember, support and resistance level, they get broken. Sometimes price can go through them from time to time. The strength of a support or resistance level determines how likely the price will respect this level before getting broken. So these are the categories. The first category is the long-term level. The second one is the medium-term level. And the last one is the short-term level. So the long-term levels, these are the levels that I draw from the monthly and the weekly time frames. And the medium-term level, these are the levels that I draw from the daily and usually on the 4-hour time frame. And lastly, the short-term levels, these are the levels that I draw from the hourly and minute time frames. Depending on the type of trader you are, you must always break the market down from the higher time frames so as you determine these long-term levels. And these are the levels that drive the market in a long term. And as you know that the market movers and the positional traders, those who influence the market movement in a long term, they tend to look and trade in the higher time frame. So if you might trade in the lower time frame, it is very good to have a clear picture and to have these levels of the long term or high time frames. And usually we call these levels of the high time frames the key point. So after identifying these key points, then you move down and identify the medium term levels, which are very crucial and they determine your take profits and stop losses. And then lastly, you identify your trading zones or levels, which are the levels that we draw on the 1 hour time frame, 15-minute time frames, and 30-minute time frames. We'll break down the market and show you how exactly you can identify and use these 3 categories of support and resistance levels, and how exactly you can use these 3 categories of support and resistance levels. But before we do that, here's a trick. You must always remember price or the market moves from zone to zone. It doesn't matter if it is in a downtrend or an uptrend, it will move from zone to zone. As you know, the habit and the character of the market movement is in a wave form. It goes up and then down, up and down, but eventually it moves up in an uptrend and down in a downtrend. But when it comes to drawing support and resistance levels, you must use this trick. Draw 3 up to 4 zones. When finding your entries, you must draw 3 to 4 zones to fine-tune your entries. Here's what I mean. First of all, you should have previous zones. So from the current price market, you can identify the previous zone, as you can see, and then identify the current zone, and then identify the next zone that the price is most likely to head. As I told you, it moves from zone to zone. So identifying the next zone that the price is most probable, is most likely to move in the coming time. So as I told you, the price moves from zone to zone. So identify the next zone gives you an edge. It gives you the advantage of capitalizing if the market starts moving to the next zone. And identifying the previous zone is also crucial if the market reverses from the current zone. And now let's have a look on a little time chart and see how we can apply these principles to a little time chart and help you identify these opportunities and take advantage of them. So we're going to break down this chart. It's a EURUSD chart. We're going to break it down from the high time frame to the lower time frame, the minute time frame. And we are going to see how we can apply the principles that we have covered in this video to help us get the opportunities, the entries. So we're going to see how we can get the entries just using these few principles we have studied in this video. So we're going to see how the multiple time frame analysis concept can be very crucial to the way you trade on the lower time frame minutes. We are going also to see how the high time frame levels, the support levels or the resistance levels of the high time frame can affect and can make you predict the movement in the lower time frame minutes. So as I told you before, the levels on the high time frames are considered to be key points. So as we move down to the lower time frames, we do predict the market according to how they have behaved in the high time frames. So marking this point as our key level, we are going to also to mark another key level on the monthly time frame. This place also was rejected previously. Also, this place had a lot of rejections, and we're going to mark it as our key level and strong support, which was turned into resistance level. So these areas are very crucial. So you don't have to draw a lot, but you draw according to the current price position. So once you have this, you go down now to the weekly time frame. Now dropping down to the weekly time frames, you just look on the areas with previous rejection points, which can be your support and resistance level. You don't have to go very far to the past data. You just draw few previous and recent highs like this and lows. So we have our weekly time frame like that, and we're going to make sure that all the recent highs have been drawn like this, which is more likely to see the price heading toward this level. As you can see, the current level, the way in the place it is. So we are going to make sure that all the weekly time frame are drawn like this. So the main goal or the aim of drawing this level is to have a clear picture. You can see price has been moving from this zone to the zone. So it comes from the previous zone and then to the next zone. So whenever you are breaking down the market, this is a picture you should create. So once we drop down to the daily time frame, you can see the daily time frame also has a lot of rejection points. So we're going to mark them to fine tune and to have a clear visualization of what's happening. You can see this is another area with the high and great rejection point. Also, we have a resistance level here. The price broke this resistance level, and we have previous support levels that price retested previously. And you can see in the daily time frame, price has been recently in an uptrend. Once we go down to the 4-hour time frame, you can see here we are going to mark our key points. But as I told you, key points are on the weekly and the monthly time frame. So here we identify our strong zone. The zones, we start to mark them as areas from this point. You can see we're in the 4-hour time frame minutes. We have clear key points as they are seen here. So whenever we are trying to trade from the 4-hour time frame, we have our clear points, which can be used as take profit and the stop losses. You can also turn these levels or key points into zones. As I told you, we don't treat these areas or these levels as particular and a fixed point, but we treat them as levels. We also draw a multiple zones, which are very crucial, as well as on the 4-hour time frame. We also adjust these key points to make sure that they are very clear. So on the 1-hour time frame minutes is the time frame that we are going to identify the picture and the structure, which we are going to use as to get our entry. So we are going to draw further zones on the 1 hour. You can see this is our next zone. As I told you, you're going to adjust as well as there was a concept I told you before that we are going to draw 3 up to 4 zones: the current, the previous, and the next zone. You can see here price was rejected and they seem to be going down. So this is a zone that price broke and was retested. So we're going to draw another previous zone. Since market moved from zone to zone in a wave characteristics, we are anticipating to see price keep pushing lower here because they broke the zone and now they are retesting. They have retested this zone and they're heading down, and you can see the bearish momentum here. And if you're trading on the 4-hour time frame, this could be your candle, and you can see the most probability move is this one. So on the 4-hour time frame, you can see the downtrend is about to begin because they have broken the previous support, and they have turned it into resistance level. So we are going to break down into the lower time frame to get our entries. And now in the 15 time frame minute, we have identified the movement, the most probable movement due to the wave characteristics. So we are going to identify our entry here. It's very simple. You can see the bearish movement, so the price is most likely, is most probable to move and go in this direction. So I'm going to place here my trade on this engulfing candlestick. So this is how I anticipate the price will behave and will move. So we are going to forward this movement. We are going to see, this is a lead time chart, so we are going to see how the price will behave according to our analysis. So what we have just done so far is analyze these levels, analyze the support and resistance level, because we know that price move from zone to zone. So we have just identified the strong zone up to these short-term levels. On the daily time frame, the price was heading higher, but our anticipation is that the price will keep pushing lower. Why? Because price is retracing from the daily time frame, and you saw on the 4-hour time frame, the 4-hour time frame was in a downtrend and the hourly time frame was in a downtrend, which means the bias is very strong, and we're going to expect the market to keep pushing lower up to this next level. And boom, we can see the price respected this zone and they move toward our direction. So this is how simple this concept can be. However, you might encounter losses on the way, but you see this trade has 1:6, one risk to 6 times reward what you risk. So once you keep trading this strategy, you'll be losing on the way, but make sure your trades have risk to reward ratio greater than 1:3. So they should start from 1:3 and above, so as to make sure that you make money in the wrong runs. So always remember, you should have the same bias. If you're trading on the 15 time frame minute, you should have the same bias from the 4-hour time frame. As you saw on the 4-hour time frame minute, we were trending down, as well as on the 1 hour, and now it was easy to spot this successful trade on the 15 time frame minute. That's it for this video. We are going to cover the remaining parts on the next video, so make sure you subscribe and hit the bell icon so as you don't miss the next video that I'll be covering the remaining technical analysis tools that can help you to get a complete picture and confluence to make you trade with confidence. Thank you.